In a few minutes. So. Are they calling for floods anywhere in West Virginia? Don't think so. I hope not. Okay, hopefully you have been working with Cengage. Has anybody finished chapter 6 Cengage? How many has started it? What percent? Say
about 60%.
60. Anybody better than 60? Kelly, where you at? What?
I don't know the percent, but I'll post it.
If you go through Cengage, hopefully it drills in some of those discounts and those entries. And the other day we practiced entries with buyer and seller. That's an important example in your book. You will have that on your next test. Entries for merchandise, buying and selling. Now, if we purchase something, we debit merchandise inventory and we credit accounts payable or cash. Now, how about the seller when he sells it? What does he debit? He debits accounts receivable or cash and credit sales. But it requires two entries. Kelly thought she was going to be the only female here this morning.
That's why I come here every day.
All right, there's another entry, say, on the seller side. Do you know what it is? When you debit accounts receivable and credit sales, you also have to debit cost of goods sold and credit merchandise inventory. All right, and basically, when you pay for something, you debit accounts payable and credit cash. You pay for your purchase. The seller debits cash and credits accounts receivable. But there was discounts in there to worry about. And there was returns in there to worry about. And a couple of new accounts. Come in, Ryan. I believe your buddy might be sick today.
Yes.
All right. Did he not make it to his engineering class? Did he not make it to your first class?
Oh, this is his first class.
Oh, it is? I thought you had one before this.
I had one.
Oh, he don't? Okay. But anyhow, did you have to walk over in the rain? Yeah. It's rained all day yesterday. It's not helping any today, is it? The PowerPoints, we looked at many of these the other day, but we're gonna have to practice a lot of these transactions, and we're gonna have to look a little bit at the appendix. But now, test-wise, I will not give you anything from the appendix, even though we will look at it. But test-wise, we will not. All right, the other day, we also looked at taxes. We know when you sell something, now you debit accounts receivable or cash, you credit sales, and you credit sales tax payable because you owe state of West Virginia sales tax. All right, there was purchase returns allowance, and we'll look at those later. I'm just credit cards, same as cash. You may have to pay a credit card expense. We're going to work on these discounts, but we'll get back to them. Freight. There's one little exercise we'll look at, but freight. Now, FOB shipping point means what? Oh, you mean? Well, you mean they pay for it? Yeah, they somebody. They who?
Right.
All right, the supplier would pay for it if it's shipping point. Okay, and wait a minute. The buyer pays for it if it's shipping port. Buyer pays for it if it's shipping port. Now, if the buyer pays $200 for freight, what is it debit? Merchandise inventory. It's headed on purchase. Now, if it's FOB destination and the seller pays the freight, he debits delivery expense. So know the difference between those two, shipping point, destination. All right. Now, what if the buyer is supposed to pay the freight, but the seller has to pay to get it shipped out? It's FOB shipping point, but the seller pays the freight for you. The seller will debit accounts receivable because you owe that freight back to it. And they'll credit cash. And then you'll debit merchandise inventory for that freight when you pay it. All right. But that's just running through the entries, which we have to practice and practice. All right. But I wanted to get you over to please study these 2 pages, looking at seller and looking at buyer. Now, taxes, we glanced at that the other day. This is your generic entry. Now, you owe $106, but the seller could only credit sales for $100, sales tax payable $6. What is the sales tax rate in West Virginia?
Overall, but there's 1% city tax.
It's 6% overall, but 1% for what?
In cities, they charge 1% service tax.
Yeah, some of your luxury things like motels or restaurants, they may have to charge an extra tax or maybe city tax, what have you. Virginia, it is 5%. Now in Tennessee, it's almost 10%. But there is no state income tax in Tennessee. And then go across the border if they want to. Then go down to Georgia or Alabama, Virginia, and pay cheaper sales tax. All right, when you send that sales tax into Charleston, just debit sales tax payable and credit cash. What is the sales tax on an automobile in West Virginia? If you bought an automobile, don't you have to pay sales tax? Now, in Virginia, it's 4%. New or used. It's the price of the vehicle without considering a trade-in. Tennessee, it's 6, but it's only on what you pay different. You don't have to pay. If you bought a $30,000 car and traded in a $29,000 car, you only pay sales tax on $1,000. In Virginia, you'd pay sales tax on the whole $30,000. How's West Virginia work? Does anybody know? Okay. Nobody's bought a car recently. Now, trade discounts, something like that, you do not make journal entries for it. If something's advertised for $1,000 at 30% off, you just debit merchandise inventory for $700 and credit accounts payable or cash for $700. The 30% is not recorded anywhere. That's a trade discount. You know, if you see a vehicle advertised for $30,000, but it's got $5,000 off, you paid $25 for it. You don't worry about that $500 discount. All right, you go out and count your inventory, and you find out that you've got 62,150. But your ledger says you've got 63,950. Well, what went with the other 1,800? You don't have what you're supposed to have. What went with the other 1,800? Well, some kind of shrinkage. Now, gasoline evaporates. In a grocery store, bananas and other produce, even veggies, well, other veggies, meats, they pay purchase, we have to throw them away. That's shrinkage, isn't it? All right, now, perpetual inventory system is only as good as the workers put in the purchases and take out the sales. People may forget to do that, and that's honest. But now this is a lot caused too by employee stealing and customer shoplifting. Okay? There was a lady that used to work at Kmart. She had 2 kids. She was a single mom. She needed her job. And the manager was good to her. She wanted to go around when she got off work, go to the employees' lounge and everywhere and pick up the aluminum pop cans. Aluminum cans, whatever somebody drank, I guess Red Bull or whatever. Anyway, she was selling those aluminum cans, which was okay, and they let her do that. But she had her black plastic garbage bag, supposedly full of those cans, and the manager one night decided to check it when she was going home. And he found kids' toys in there. So she was stealing one. That was employee pilfer. She lost her job. I don't know how she ended up supporting her 2 kids, probably welfare or something, so she got another job. But don't jeopardize what you have for something that's not yours. That's what she did. All right. And people have gotten together before too in cahoots that work together to steal stuff. That's employee pilfering. Anyway, that entry, you've got to bring your inventory down 1,800, and you're credited to do that. And you put it in cost of goods sold. Okay, now customer refunds. Now here is your unadjusted balances for sales. Now here's estimated inventory 300, customer refunds, payable 800, an estimated cost of merchandise return. I don't like some of those accounts, but we have to live with them. If you estimate that 1% of your sales is going to be returned, then you debit sales to take it out of sales. That reduces sales. And you credit customers' refunds payable. All right. And then, of course, estimated returned inventory. Here you got $5,000, and that reduces cost of merchandise sold. If they returned it, reduces cost of merchandise sold. I don't like these entries. The other book was better on these, but this new book is better on some. This new edition. All right, now here's what I want us to look at. All right, this is called a multiple step income statement. Now, before you had revenue minus your expenses, and you got net income. It was that simple. Revenue minus expenses is net income. Very simple. Okay, but here you may have to break down your operating expenses into sales and administrative. They speak for themselves. You can read those and know which one is selling and which one is administrative. All right, if it has to do with the office, it's administrative. If it has to do with anything with selling, it's selling. Now, also on a multiple step income statement, you may have other revenue and expenses. And here you have, all right, rent, revenue, and you have interest expense, and you have to put the difference there. That gives you final net income. Before, you just had income from operations, so that's expanded a little bit. This is a single step income statement when you put all the revenue together and all the expenses together. You will not have one like that on a test, but you may have this one on a test. And you'll have this one for homework for Tuesday. Now, those that got along with Cengage so far, have you had to do one of these on Cengage? Not yet? A lot in this chapter. Now, owner's equity for merchandising business does not change. It's the same as you did on the test you had the other day. Balance sheet does not change. All right, sure, you've got merchandise inventory and you've got estimated return inventory, and down here under liabilities, got 2 or 3 new things on the balance sheet. You have merchandise inventory, it's an asset. Estimated return inventory, estimated return would be an asset. All right, you will get it. That's a count I don't like, but we'll live with it. And then down here is customer refunds payable. If you owe refunds, it's a liability. So the balance sheet doesn't change much. The equity statement, not at all, but you've got that income statement that is totally different. Now, closing entries, you still close out revenue with a debit, and you close out expenses with a credit. And you got to close out cost of goods sold, and I don't see any other strangers down through there. You still put net income into capital, and you take drawing out of capital. Closing entries hasn't changed. Okay, asset turnover is just a little ratio. I am not worried too much about ratios, but I would abbreviate that AT over sales equals sales divided by average total assets. How do you get average total assets? You take beginning assets plus ending, all right, and you divide by 2. Beginning plus ending divided by 2. They give you some examples here. Your assets turned over in year 2. All right, now what is this? Is this, they didn't work it on out, did they? Oh, here it is. Which one is better, bigger or smaller? Sometimes when you see numbers and scores in golf, which is better, bigger or smaller? Baseball or basketball, which is better, bigger or smaller? All right, that's the same way with some of these ratios. Bigger is better. Year 1 was better. The more times you can turn your assets over, maybe the more sales, the more revenue, and everything you create. Now, the appendix, I'm just going to say a few things about it. It will not be on a test. We will look at some homework, but periodic. Now, in a periodic inventory system, you have to calculate cost of goods sold. Perpetual, when you sell something, you debit cost of goods sold, and you credit merchandise inventory. Periodic, you don't do that. Periodic, you have to take beginning inventory plus purchases, gives you merchandise available for sale, minus ending inventory, gives you cost of merchandise or cost of goods sold, same thing. All right, in a periodic inventory system, I just don't think it's used much anymore because of computers. But here are some of the entries, and you can compare them to perpetual. All right, here you debit purchases and create accounts payable. Now, under perpetual, Saith, what did we say we debit? You did that a minute ago. Under perpetual, we debit what?
We're gonna debit
Accounts
No. You're buying something. There's no need to have accounts receivable when you buy something. Right, you're gonna debit merchandise inventory, okay? All right, here we debit accounts payable when we return something, credit purchase returns and allowance. All right, pay for purchases. Here we take a purchase discount, whereas we record at net. We record merchandise inventory at net. Would have taken out to 2%. And now here are sales. All right, the cost of merchandise sold was $9,000. You don't make that entry either, but you are recording accounts receivable at net and sales at net. And here under purchases, we don't debit merchandise inventory for freight charges. We debit freight in. We'll add that to it later. All right, so there are some differences, and you need to look at those differences and compare them on a periodic system. All right. Here is what I was under purchases. You take your beginning inventory, you take purchases. Now you got to take out these returns, allowance, and discount. You get net purchases. You have to add freight in. So cost of items purchased and merchandise available for sale and less ending inventory. You finally get down to cost of goods sold. A lot harder process than perpetual. Perpetual, you record it in every sale. Perpetual is best. Perpetual is used because we have computers that can make perpetual easy. But before computers, periodic was more popular. The closing process is not a lot different, but you got a lot more accounts. You got to close out your merchandise inventory and estimated returns and discounts and allowances. So you got a few more debits up here to close out. You have a few more credits here, but we'll look at those. We'll practice them. All right. So now we need to practice. First thing we're going to do is look at exercise 13, page 324. All right. Now this one, just how much do we pay? Here in A part, we had merchandise, FOB, destination. I don't see any freight, but I do see a customer return. So to get used to this, how much do we have to pay out in cash? A, subtract real quick and you got it. If you have a calculator, please get those out. Well, and Sandra, it looks like the left side has best attendance. You know the side that has worst attendance has to furnish pizza on the table.
Well, it looks like a pizza place.
It was?
I work at a pizza place.
Oh, you do? Well, that may become a reality. We have pizza on the table.
It looks like, they're not getting pizza.
It brings in about 8 o'clock in the morning. Okay. Anyhow, what's your answer on that one, real quick? 10 what? All right, now we get down to B part, and we have freight paid by the seller, but it's FOB shipping point, and we sent back $900. Okay, you take the 21.2 we sent back $4,000. Now, what do we do if that 380? The seller paid it, but it's FOB shipping point. What do we do with it? We add it on. We have to pay the seller back because it was our expense. So 21,000 minus 4,000 plus 350. Number 6, C part, just minus 900. D part, the same thing. Take 7,500 minus 12 plus 250. And E part, 28,800. That's just all you owe. But trying to get you used to FOB, destination, and so on. All right. I want you to do exercise 10. Take a minute and do exercise 10 on sales related transactions. And if you get finished before everybody else, do exercise 16. Once you do exercise 10 and 16, just put it on plain paper. Your table has a calculator. Okay, how much of a refund does the customer get in this problem? He returned the whole shebang, right? Now, the seller probably recorded that net. All right, 98% of that is how much? That will work. 2% subtract what? 60,000? It's 28,000 now.
It's the cost of merchandise.
Well, that was the cost of merchandise return, yeah. But you sold it for 28 with a 2% discount. So I'm the buyer. I don't want the cost refunded me. I want what I paid for it. Now, how much is that? Like 27 something, 440. Okay. So here is your answer. 27, 440. That's what you're going to get refunded because that's what you are paying. But now the other entry does have something to do with the cost. What entry would you make? Anybody? What would you debit? What? What do you debit for that inventory? All right. Got two entries. You got to debit customer refunds payable, credit cash. Assuming you had made that entry before anyway. Now, you got to put it back in the merchandise inventory, don't you? The cost of it, 16A. And you want to credit estimated to return inventory. Not really estimated, but this entry, don't like it. I wish they'd put sales returns and allowances, because it is a sales return. But they changed it from sales returns and allowance to estimate inventory return. All right, but we got to get used to these refunds payable and these returns. All right, now let's take a minute and look at exercise 16. You at home, if anybody's watching, I don't know how many is still watching. I know we got 11 here, and I know Joshua is solid. That's 12. Anybody else is there today? I don't know how solid you are. I know I have at least one live stream and take it off the tickets. When we start out with 20, we'll just end up with about half. So, but anyhow, if you don't come to class, if you don't do Cengage, if you don't work extra homework, if you don't study, you drop by the wayside. Okay, on number 16, you got a sale and you have sales tax of 8%. The question is, should the sales tax be recorded at the time of the sale or at the time you receive the money? When should you record the sales tax? Time of sale, yes. All right. What is the amount recorded as sales? How much? 36,000. What is the amount debited to accounts receivable? 36,000 plus 8% of 36,000. All right. What is the title of the account to which the sales tax is credited? What? Sales tax payable. All right. Assuming, and hopefully all of you got that one. Kelly was the only one seemed to answer. I guess it's here at the bottom where they crowd these together. Time of the sale, 38,880, sales tax payable. That was pretty simple to do that one. Okay, now I want you to work on 19. If you get it finished, go to 20. Practice 19 and 20. Okay, on number 19, how much inventory was missing?
$5,000.
And what did you debit?
That's all.
All right, you take it out of cost of goods sold and you credit the inventory. That's an adjusted entry for inventory shrinkage. No matter how it shrunk, lost, stolen, perished, or whatever. Take a second and work on that next exercise. Look, estimated percent of refunds for current year sales is 1.2%. So all you had to do is multiply 51,600,000 by 1.2, and what did you get? $619,200. They take that out of sales and they credit customer refunds payable. All right, so they got 619,000 set aside to refund people who return items. So that's when they will debit customer refunds payable and credit cash or credit your accounts receivable. Now, B part, I don't know if we can see it or not. All right, on B part, I think we can see it. Debit estimated returned inventory and credit cost of merchandise sold. That reduces cost of merchandise sold. Now, where'd you get the 400,000 from? It's given, isn't it? It's given. All right. So you just had to answer question A and B. The 400,000 is given. You only had to multiply by 1.2. These other estimated returned inventory, customer refunds payable had nothing to do with your journal entries. You just have to add to those. You already had 28.1. You're adding 400 to it. That's all you're doing. Okay, so that's some sales transactions. I don't want to get to closing yet.
This exam will be on 6 and 7. That's what we have.
Yeah, 6 and 7.
Well, will it be like our last exam where we have like a chart?
Yes. It'll be your last exam where you have any kind of income statement, equity, and balance sheet. Chapters 8, 9, and 10 is on inventory, bank reconciliations, and so on. They're totally separate. So, but I think your exam is probably easier. It will be all multiple choice exam.
This one,
The last, this next one, I don't know. I'll tell you later. Anyway, I had a little lady come in yesterday where we'd done her taxes last year in VITA, and she's a Filipino lady. And she wants to talk all the time, and we had a whole room full of people getting their taxes done. I had 10 students start doing taxes, and I think I rushed her out, but she had to pay some estimated taxes. But now she was getting $36,000 a year alimony. Not bad alimony, is it? Okay. So it ended up her husband, the doctor. But what was funny about her visit, she was talking about her age, and she'd like to find her a mate and so on. And I asked her, she asked me my age. She said, well, you're the color of a Filipino. I said, well, no, that's Cherokee Indian. So, but anyway, I asked her when she was going back to the Philippines. She said in January. And I said, well, get your husband while you're over there, bring him back. She said, well, now, a lot of them like that. That gives them a free ride to America, gives them a free ride to citizenship. A lot of them like to come over here. But she was funny. She's 74 years old, looking for a man. So, it's pretty good. She was saying that there's more women available than there are men. Think that's the truth? More women available than men?
possible.
Huh? But you get older, probably so, because the women have killed off the men, you know, arguing and griping at them, the men die younger. That is statistic. Men die a little bit younger than women. So anyway, she was funny, and okay, so I guess what I'm trying to say, there's always hope for everybody in here. She said before, looking for a man. But now, if any of you young men are interested, I'll give you her number. She's making good money, Social Security, alimony. And so, if you're not interested in finishing your college degree, we can get you taken care of as long as she lives. She said she wouldn't care to be a cougar. You don't know what a cougar is? What is it, Johnny? What? Sugar mommy? Yeah, it's an older woman, younger man. Okay. But anyway, now, girls' average age in here today is probably 20 years old. And some of you 19, 21, what have you. But the life expectancy right now is 80 something. But for you all, your life expectancy should be about 100 years old. So I'm saying, if you got married when you're 20 years old, Kelly, I'm throwing this at you and your neighbor back there. If you get married when you're 20 years old, what are you, 19 or 20?
I'm 18.
Oh, you're still 18. Oh, you're the youngest one in here then. Is anybody younger than 18? Okay, Kelly, let's say you get married when you're 20 and you can live to be 100 years old. You have to live with the same man for 80 years. So that's why women now, a lot of women wait till they're in their late 20s or 30s to get married, because life expectancy is a long time. Used to be you were an old maid if you weren't married time you were 25. So, anyway, that is your marriage lesson for today. So let's move on with accounting. Okay, I want us to go back and look at page 323. I want us to look at some purchase. Remember that 8 and 9, we did those. So remember those. I want you to do exercise 5 real quick. Put the journal entry down on a piece of paper, exercise 5. Okay, in exercise 5, a retailer is considered the purchase of 500 units of a specific item from either of 2 suppliers that offers this deal. Supplier 1, $40 a unit, total of 20,000, 110 net 30, no charge for freight. Okay, what is 1% of 20,000? All right, so you'd have to pay 19 what? Okay, on the next one, a total of 19.5 with a 2% discount. But you add on freight of 500. So what did that one come out to be? Now, some of you one day could be in purchasing, and this would be important to know what you're doing. All right, which is the best deal? Take out a $3.90 discount, you owe $19,110, but you gotta pay $500 freight, but you still save $190 by Golden Supplier 2. So if you were in purchasing for a company, you would have to make those choices. You'd have to be wise enough to make those choices in favor of the company to save money if the product is identical. What?
The extra one, but I can get it 2 weeks early.
Right. And a lot of times it depends on how fast they can get it to you and how quick you need it. A lot of other items to consider. Okay. Now I'm going to give you some extra homework before we do one or two other items. That extra homework is problem 5A. I want you to do this before Tuesday, a multiple step income statement. I want you to practice that. And I want you to practice 3A. I want you to practice interest for buying and selling. All right, I want you to read the appendix. All right, that's 2 solid problems. Excuse me, read the appendix and try to have your C gauge finished by Tuesday. Don't have to, you only have to have it finished by test day. But try to have C gauge chapter 6 finished by Tuesday because we're going to start chapter 7 soon. We've got a lot of practice here to do. Now, for the rest of this period, you're going to practice a little income statement. And those at home, I want you to try to do the same thing. And we're going to practice a simple income statement. I want you to turn over to exercise 25. Now, if you were going to do an income statement and you look down through there, yes or no? Does accumulated depreciation go on an income statement? Exercise 25, yes or no? No. Administrative expenses? Yes. Building? No. Cash? No. Cost of merchandise sold? Yes. Interest expense? Yes. Capital? No. Drawing? No. Merchandise inventory? No. Notes payable? No. Office supplies? No. Office supplies expense? Yes, but not office supplies. Salaries payable? No. Sales? Yes. Selling expense? Yes. And sales store supplies? No. All right. So what I want you to do with this little exercise 25 is do it now and hand it in before you leave. If you can do it in 5 minutes, you leave in 5 minutes. If it takes you half an hour, you leave in half an hour. It's real easy. Look up the one in the book, but you got a long one for home, okay? But now here's the long one on page 304. But yours is a lot shorter than that.
We do this simple one right now.
Yeah, I want you to do that little one right now. Turn in before you leave. Some of you do it in 5 minutes. Some of you do it in
Then
20.
what were the 2 problems you wanted us to work on? What did you want us to do first?
All right. She was asleep on her cell phone. What 2 phones did I give you for homework? 3A and what? 5A. 3A.
Okay.
Just kidding.
All right.
you at home should practice this, so I'm going to cut off the video because nothing else is happening, except you should do the same exercise like the class is doing.